Good morning, everyone. We apologize for the late start. We had some technical difficulties. We've actually been talking as if we've been doing the podcast for the last 10 minutes, but none of you heard any of that. So we realized that and we've restarted the podcast. And so we hope that you can hear us and see us now. So a big warm welcome to everyone. Thank you so much for joining us. We're really excited about today's podcast for two reasons. One, the topic is important, but also we have two amazing panelists joining us today. And so we want to give everyone a warm welcome. The turnout and registration for this podcast webinar has been incredible. And we thank you for taking the time. We know how busy everyone is. So before we get underway, I'll do something that I forgot to do when we were talking and no one was listening. So this is a redo for all of us. I'm supposed to read a disclaimer that gets the three of us off the hook for anything that we might say that we shouldn't. So the disclaimer is the information provided in this podcast is for general information purposes only. Nothing said during this episode constitutes legal, financial, or professional advice. Always consult with a qualified professional regarding your specific situation. The views expressed are those of the speakers and do not necessarily reflect the views of any affiliated organizations. So there you go. We can say anything and we get off scot-free. Not really. So again, a big warm welcome to everyone. The topic for today is financial ABCs, audits, budgets, and cash flow. Very important topic. We're focused on the operation side. We're going to talk about reserve fund accounts and reserve fund studies a little bit. We're going to touch on that. But that whole concept of reserve funds, the idea of reserve funds and funding the reserve fund, we're going to be saving for another podcast later in the year. So we're focused mainly on the operating account. And to help us do that today, we have two amazing panelists joining us. So we'd like to give a big warm welcome to Jeremy Ouseley from OHCD and to Lyndsey McNally from Condominium Lending Group. Welcome to you both.
Thank you.
So Jeremy is with Ouseley, Hanvey, Clipsham, Deep. I think I got that right.
Correct.
OHCD. Jeremy, maybe you could tell us a little bit about OHCD, who you are and what you do.
Of course. So I'm a partner with OHCD LLP. We're chartered professional accountants. I basically oversee audit and review engagements, assurance engagements for various clients. We primarily specialize in not-for-profit organizations, as well as we service a lot of real estate entities, but our specialty is condominium corporations.
Excellent. Awesome. Thank you. And warm welcome to Lyndsey McNally. Thanks, Lyndsey, for joining us. We're excited about you being here. And you came in last night from Toronto. You're right in Toronto?
I live a little bit east of the city.
East, okay. Okay, good. So you're not stuck right downtown with the crazy traffic and stuff trying to...
No, that's where I'm from, but I moved out of the city proper almost 20 years ago now.
Okay, all right. Leafs fan?
Not really a sports fan. I like to go to live sports events. I like the energy. I find the atmosphere to be really fun, but I don't really care who wins or loses. I just hope everybody has a good time.
Oh, no.
I know.
Okay. Well, that's all right. We're happy and you can still stay. And I won't say anything about the Leafs being a Sens fan because we have so many Toronto guests joining us today, registrants joining us today. So I'll say we like all of the teams. I'll take one of your lines.
Yeah, there you go.
And we just hope that everybody has fun. Tough game last night, though. I guess if do you follow hockey at all?
Not personally.
No. John, do you, John? Oh, man. Okay. Well, for any of you who do, yeah, it was a tough game last night. Oilers lost, Panthers won, and were awarded the Stanley Cup last night. So
I did come across a dog on the internet who predicted that the Oilers would take it in 7. So that's not what happened.
No, it's not. No. So his credibility is kind of down the
that dog. Jeez.
Yeah. I hope a lot of people didn't put a lot of money on his prediction. So Lyndsey joining us from Condominium Lending Group, and maybe Lyndsey, you can tell us a little bit about what Condominium Lending Group does and who you are.
Sure. So at the Condominium Lending Group, our focus is helping condominium corporations find financial options when there are shortfalls in their finances. You know, typically that's for capital repair projects, but there are other reasons why condominium corporations sometimes need to borrow. I am a more than 20-year experienced condominium professional. So I have a background in condominium management before I started working in this capacity. So I try to bring some unique operational perspective into financial challenges for condo corporations, and I'm able to provide a lot of advice and support to my clients about their financial position and what their options are. I also teach at Humber College the regulatory course for all new condominium managers coming into the profession in support of their license. So, I really enjoy working with condominium corporations. I really enjoy educating people about, condominium issues. And I'm just really happy to be invited here to your podcast.
Oh, thanks so much. Yeah, well, we're all about education at the Condo Collective. It's a huge thing that we try to encourage and try to facilitate is more education about the industry. So thanks again to both of you for being here. So as I mentioned, we're focused on financial ABCs, audits, budgets, cash flow. And what we're actually going to do today, just as a format for our discussion, very loose format, because we know it's informal and very conversational, but we're kind of going to walk through a fiscal year. So we're going to look at sort of the main events that take place throughout the fiscal year, what property managers need to do, what they need to not do. Jeremy's going to talk a bit about audits, what the auditor needs from the property manager and from the condo corporation, when they need it. And we're going to look at some of the aspects regarding budgets, how we can use the audit as a tool for budgeting, and we'll follow that through the fiscal year. So let's start with the budget process. So before talking about the budget itself and the board looking at the budget and approving a budget, there's a whole bunch of work leading up to that that property managers have to do. And that's with respect to budget preparation and even research and compiling of information and data so that they have what they need to be able to prepare the budget properly. So Lyndsey, maybe we can start with you, and you can share with us a little bit about budget preparation and what are some of the important things that a property manager really needs to consider even prior to putting pen to paper regarding the budget.
Okay. So the first thing I want to always tell people is that you have to keep in mind that the budget is not an event itself. It is not something that happens at a particular point in time. Although you do put pen to paper in month 10 when you complete your 9-month financial statements, the budget is a process that happens throughout the entire fiscal year, where we have variances, where we have wish list items, where we have things that we want to change in the condominium corporation. As condo managers, you have to be really organized and kind of getting your notes together and making sure that you have enough detail to do the budget when it comes time to actually, put the numbers on the page for your client. The other thing too that's really important is monitoring the corporation's overall financial position leading into budget preparation. And this is something that's often overlooked. Managers will typically look at the statement of operations, income and expenses, performance for the current fiscal year, and they're just worried about preparing a budget that's going to support their expenses, which is good. You do want to do that, yes, obviously, but one of the things that's often overlooked is looking at that statement of financial position, the balance sheet. What is the corporation's overall financial position? Are they running a surplus? Are they running a deficit? What adjustments do we need to make to our budget in order to better support a healthy overall financial position for the condo corporation?
Excellent. Yeah, for sure. So that initial preparation, gathering of data, historical data throughout that fiscal year, where every single GL account is at that point in time, and then doing our best to forecast what's going to happen through the balance of the fiscal year for all of those. Great suggestions and reminders. Jeremy, one of the things that I've noticed, and I think we agree on this, is that the audit is often not used as much as it should be as a tool by managers. And we often will, rush to try and get the budget done. You're going to talk a little bit about that as well, the timing of all this stuff. So we rush to get the budget done. We want to get it into the AGM package so that we can get the AGM package out on time according to those deadlines in the Condo Act. And then it gets presented by a wonderful auditor such as yourself at the AGM to the owners. But then what often happens is it just gets filed away and nobody ever looks at it again, maybe until the budget preparation of the next year. But it can be a really useful tool throughout the year, and it's certainly a vital tool in budgeting for the next fiscal year. So maybe you can tell us a little bit about the budget process and how it works, and a little bit about the importance of the budget for board members and for unit owners.
Thank you very much, Mark. So I must first and foremost admit I am biased as an auditor, and I would say that the audit provides tremendous value. But you are correct to point out that the timing of the audit happens subsequent to the year end, which is much later than the budget process when that normally occurs. Budget process, as we know, typically happens before year end. Then once the year end comes to an end, the audit process should start within a few months after the year end. And that audit process does result in often audit adjustments, which can make the results of the fiscal year change. And when considering the budget process, the board and management has to consider what year-to-date expenses and revenues have occurred, what forecasted revenues expenses will occur, to ensure that the year-end financial statements are as accurate as possible before the auditor comes in and provides an assurance engagement, whether it's an audit review process for that fiscal year. And once an audit is completed, I always think that the board needs to revisit the financial statements and the budget process to see, has there been material adjustments that need to be considered when completing the fiscal year? If there has been a material change in year-end figures, as Lyndsey pointed out, it's very important to consider the balance sheet and whether or not the operating surplus or deficit is in line with what the board and management expected, whether or not there needs to be a revision to condo fees or special assessments. That is a decision that certainly can be made once an audit is completed and a true financial picture can be presented to not only management and the board, but all owners of the corporation.
Mm-hmm. Yeah. So really important for the accuracy of the audit that the auditors receive the correct information and that they receive it on time. So let's just go through that process a little bit because I know this is something that managers struggle with because everybody is so swamped. And this is something that will often get pushed and pushed and pushed. And I'll admit I've done it myself. And OHCD has been unhappy with me for doing that. But I think it's happened to most property managers at some point in time. Hopefully that's not our general practice. But looking at the timeline a little bit, from the date that the AGM package is going to go out, we have to kind of count backwards a bit. So how much time generally do you need from the time you receive all of the documentation related to the audit? How much time typically does the auditor take to actually complete, let's say, the draft, the first draft?
I think that's a completely fair question. And often that is an environment that's not perfect, and we're often working with incomplete or imperfect information, but we do our best to deliver a draft in a timely manner. Once we get given the go-ahead from the property manager to conduct the audit based on our reappointment from the prior year or new appointment for the upcoming fiscal year, we typically prepare an audit planning package and wait for the documents that we request to be provided to us before we start the audit. At the point at which we receive the documents, we typically estimate between 2 to 4 weeks to turn around a draft package. But that also is subject to change, because if you have an AGM in 6 months and give us everything at 5 months, then the turnaround time can be longer because there's other clients giving you information all at the same time that we have to balance and juggle other client demands. And coming up to the end of June, this is now the busiest AGM season, given that the most condo corporations have December year ends and most corporations generally have December year ends. So it's a very, very busy time. So that time can fluctuate depending on time of the year and how busy it is. However, I always recommend within a month of year end, the financial statements should be reviewed and approved by the board. The audit process should be started. If we're looking to start December audit from February to March, your turnaround time with TIP will be much better than right after personal tax season in April or May.
Mm-hmm. Yeah. So that's that gives enough time, and we're starting nice and early. And then, often there are some hiccups in that process on the property manager's end, and oftentimes all the documentation will be sent, but then the auditors come back to us and say, there's this missing, or there's this issue with this particular record or whatever it is. And so we have to allow time for that. And then the other area where we have to allow time for is the turnaround for the board, because sure, we have the draft in our hands now, but the board needs to review that, right? At the bare minimum, the treasurer should be reviewing it, but the package asks for 2 signatures from board members on there. So really it's the entire board that should review it. Maybe the auditor is tasked by the board to take the lead in that. And then maybe the board has some questions, right? And those need to go back and forth to the auditor to get ironed out until the board is happy and content. And then they get the signatures. Now, all that is a signed draft, right? And we still have to get that back to the auditor, and the auditor has to turn around the finals, which then we can include in the AGM package. So.
Yeah, I mean, well, hopefully if the property management company, whoever's doing their books is doing their job right, and then the property manager themselves is doing their job right and reviewing those financial statements, I mean, the unaudited financial statements every single month, making sure they're maintaining accuracy in the statements, there shouldn't be a lot of surprises at audit time. Like, the hope is that everyone is doing a nice job of keeping things accurate. The board has reviewed the unaudited statements, and the audited statements at least somewhat align with that performance. Accrual adjustments aside, the auditor has the benefit of hindsight where the manager does not. But hopefully the audit that you're getting, it's not substantially different from the unaudited statements the board's already reviewed and approved.
Yeah, that should definitely be the case.
I echo those comments completely. There should be no surprises when an audit is completed. In a perfect world, there should be no audit adjustments. All adjustments should be built into the financial statements. But as Lyndsey mentioned, we have the ability of using hindsight to make sure that other entries need to be put into the financial statements through the accrual basis of accounting, which the property manager doesn't always have when they're completing financials within days or weeks of the year end. However, we always encourage boards to review monthly financial statements throughout the fiscal year, so there's no surprises. When a draft audit is received by the board, we're more than happy to have meeting with the board, answer questions, that sort of thing. But the questions of variance analysis or why expenses are higher or lower aren't really directed to the audit. They should be directed to management throughout the fiscal year.
Yeah, for sure. And we actually have our property accountant review the monthly financial statements with the property manager. They look at them together, so they're able to pick up on any issues that there might be, and then able to correct them. If there's an adjustment entry that's needed, then that can be done. So really important that that's done on a very regular basis, and looking at those financials and reviewing them, making sure everything's good. So let's talk about moving into the actual creation of the budget itself. So we've kind of done that legwork. We have the information for the budget. One of the things that I think, again, can be used and should be used much more from the audit is the trial balance. When we get the audited financial statements, the categories have been grouped together, right, Jeremy? Typically, yep. Yeah. So those audited financial statements, all of the GL accounts, they're depending on the size of the corporation, there can be a lot of them. And if they were presented that way to owners, they're not readable. So what auditors will typically do is group those into similar categories. So there are fewer line items for boards and owners to be able to get through. But that means that if the property manager is going to enter accurate historical information for every GL account to determine what the new number for the next fiscal year should be for that GL account, they have to use the trial balance, right? Because that's where the accurate information is for each one of those GL accounts. So do you want to comment on that, Jeremy? Because what I've found is often managers don't do that. And to me, it is an absolutely essential tool for the budgeting.
I would agree the trial balance is a very important report. It should be included in every monthly financial package provided to the board. And it is a snapshot in time of all the accounts for the Condo Corporation's financial records. It captures balance sheet, income statement accounts all in one report to show the cumulative year-to-date balance for that specific account. And often we do find discrepancies even with the opening net asset balances for the general fund and the reserve fund that should tie to the prior year audit figures, simply because the property management firm hasn't entered in last year's audit adjusting journal entries. And then as a result, the trial balance will be incorrect for the entire fiscal year until those figures are posted. And I always recommend that these trial balances should be reviewed in every set of financial statements to help identify any unusual transactions. And it is a very valuable tool.
Mm-hmm. Yeah. Yeah. And so, the big issue there is with accounts that have accruals associated with them, especially utilities. And if those, if the property management firm only uses the information, if their year end is December and they use their own produced financial statements that come out the beginning of January, might be the beginning of February, if that's when their year end is, then probably there are no accounting adjustments related to accruals, because that's usually what the auditor takes care of. So if they're not using those numbers and the trial balance that comes with the audit, then they're using inaccurate information, or they're calculating the accruals themselves, which maybe they should be able to do, but it's so much better to use the auditor's numbers. So let's get into the budget process a little bit. So what are some things to think about, Lyndsey, when it comes to a manager creating that budget and then sitting down with the board and having that all-important budget meeting with the board? What are some things they need to think about? What are some things they need to communicate properly to the board through that budget document and in that meeting?
So I think one of the challenges that managers get into a lot with budget preparation and budget presentation to the board of directors is that boards sometimes will focus on stuff that, I don't want to say it's not important, but stuff that's not discretionary. When you break down by percentage the items, the categories in a budget for a condominium corporation, I think you actually find that the board and management has a lot less discretionary spending than the owners might think that they have. They're going to have their statutory obligation to contribute to the reserve fund. Very little they can do about what they need to save to do future repairs on the property. They're not going to have a lot of discretion in terms of utility costs. And when we look at like a high-rise environment, 25 to 50% of your utilities, of your overall budget could be utilities, depending on, what type of electrical service you have, how are the units heated, those types of things. So there's some variability, but these things can make up a really substantial portion of the budget. So managers really need to develop some skill at drilling down in the budget to the things that are important, helping their board focus on the things that are important. What by percentage contributes like the largest amount towards the increase that you're facing, right? And if there's some discretionary spending there, certainly you can talk about it. But if it's your reserve fund contributions that are driving 100% of your increase, it's something you have to kind of accept and move on from, unless you're going to go and take a bigger look at your capital repair plan and revise your reserve fund study. That's something that can be done too. But one thing that I've always done with my board clients and doing budgets is I kind of help them to understand first what does 1% actually represent in your budget? If you don't like your 5% increase and you want to give a 3% increase to the owners, how much money do you actually have to cut from the budget? And can you even do that based on the discretionary spending that you have available? Sometimes not. Sometimes you just have to take that hit when it's due.
Yeah, for sure. It's such an important point. And the reality is, like you said, the biggest line items on the budget typically are not discretionary spending. They're kind of in stone, and that's just how much we're going to spend. Reserve fund contribution, utilities, insurance, right? Those are probably the big three. And there is little to no discretionary spending. I mean, you can go get insurance quotes, but the reality with insurance is the price is not going to be a big change. Even if you go out to tender and you do that. So yeah, and it's funny because it's one of the most common reactions that is typical among any board of directors, that when you have a new board member and you sit down to go through the budget process, and the new board member starts out saying, we don't want any condo fee. We want a 0% condo fee increase. And so the manager says, okay, well, let's just go through the budget draft line item by line item. And the board members' eyes start to get big because they realize, oh, no discretionary spending there, no discretionary spending there. General maintenance, okay, maybe there's some discretionary spending there. Okay, well, but we spent 20,000 last year. We spent 25,000 the year before, and we spent 20,000 again the year before that. So how much discretionary spending is there really?
Yeah,
right?
It's an important point you bring up, actually, because when we are dealing with condo boards in budget presentations, there's always that downward pressure, at least from one board member.
Sure.
I don't want fees to increase.
Sure.
And property managers, I think, to some degree it's human nature, but like property managers, you get to know your clients and you're preparing a budget, and maybe you have a big increase in the budget and you go, oh, gee, that Bob on the board, he's never going to approve this budget the way it is. And you start to try to cut the budget down to a level that you think the board is going to be okay with. Well, what happens when you do that? You bring a budget that's already been cut down arbitrarily to a group of people who are going to cut it down further. And if you started with an accurate budget, at the end of that process, it's definitely no longer accurate and will not support the financial position. So a manager's job is to put forth a budget that they think will reasonably support the corporation's financial needs. And they have to be prepared to have hard conversations about it, whether or not they like it.
Absolutely. Yeah. And that's part of the job, is to give the news, whether it's good news or bad news. Right. So that's such a good point, bringing in the budget without going through and, sharpening your pencil, as the saying goes, beforehand. Just bring in the accurate budget that we feel is accurate. We've done all our research. We should have information and data to back up why we've chosen that number for next year. And there should be data for every one of those items. It's not a process where we just throw a dart at the board, right? We can be a lot more accurate than that.
Just to add on to that, and discussing financial needs specifically, from my perspective, any corporation, and that includes condo corporations, need working capital. You need cash in the bank to pay the bills. You need cash in the bank when the insurance premium comes up the first day of the fiscal year to pay that off. We would never recommend that a condo purely runs a break-even net assets position in the general fund, because you need that working capital. It's prudent, financially responsible for the board to have that working capital available, such that you're paying your suppliers. If an emergency repair comes up, you have the cash to make those payments and pay for the work that needs to be done. So often I see boards budget break-even budgets and not plan to have any net assets or cash in the bank, but that is not fiscally responsible, in my opinion.
Yeah, that brings us kind of back full cycle to one of my original points here, which is you can't just look at the income and expenses, the statement of operations. You need to look at the corporation's overall financial position and cash flow. The reasons why we need to maintain healthy surpluses for cash flow, they tend to go over the heads of the board of directors a lot. You know, they don't want to take more money from the owners than they think they absolutely need, especially as a not-for-profit organization. But just because you're trying to run a zero-based budget doesn't mean your cash in the bank should be zero at the end of the year.
Yeah, that's the important principle, right? One of the things we always look at is that we have an insurance premium to pay. Now, we can choose, the board can choose to pay that through monthly installments, but obviously there's a financing cost that comes with doing that. So if the board can and wants to avoid that financing cost, then you pay the entire premium at the beginning of the fiscal year. But you have to have the money in the bank to be able to do that. So it brings us back to the C in our ABCs of finances, which is cash flow, and making sure that when we do that budget, if we're able to get our corporation to the point where they have enough cash, at least to cover that insurance premium, then we're doing them a favor. We're helping them out, and we're helping them to avoid incurring other costs. The other thing we're helping them to do is doing something with respect to the reserve fund contribution that we really shouldn't be doing. You want to talk about that?
When you say that, do you mean not making your reserve fund contribution?
Delaying the contribution.
Yeah, delaying the contribution. Yeah. You know, the insurance premiums are really just one example of why it's important to have a healthy cash position for a condo corporation. What we have to understand is that the way that we spend money and bring in money in condo corporations are different. We know that the money is going to come in nice, equal, 12 even chunks. When we spend money for the condominium corporation, it doesn't work like that.
All over the place.
Yeah, we have seasonal variances, and when work has to be completed, we might have collection issues, we might have delinquent accounts, especially if we have shared facilities. So really important to maintain that healthy cash position. That healthy cash position helps us to make sure we have the money in the bank to make those reserve fund contributions on a monthly basis. And a lot of condominium corporations, when they find themselves in sort of budgetary or cash flow distress, the first thing that they do is say, oh, well, we'll just make our reserve contribution next month or next month. It's not strictly contrary to the Act. The Act doesn't say when exactly you need to make your contributions. And I think, you know, from an audit perspective, as long as all your contributions are made at year end, no one's going to kick up a fuss. But if you do not have sufficient cash flow to support those monthly transfers to reserve, your reserve fund is not earning the interest that it needs in order to bring its own balance up and have a healthy fund on that side. So poor cash flow planning on an operating side can have a major impact on the corporation's long-term ability to make its capital repair obligations.
Mm-hmm. And it's no solution. All it is kicking the can down the road. Right? Yeah. And so, Jeremy, do you see that often when you, or sometimes when you start in on an audit and you look at the transactions that have occurred and you see that regular contributions haven't been made, and by this point in the fiscal year, there are a lot of outstanding contributions? Is that something you see?
It's quite common, and it seems to be becoming more common. We do like to see when condo fees are collected monthly that they are contributed to the reserve fund on a monthly basis. However, when we conduct our audit engagements, it's something that we do look for, and we will put a comment on in our auditor's report under other matters if there's a contravention of the Act, if an amount hasn't been contributed to the reserve fund by the year end. But we're not commenting on throughout the fiscal year. It's just a point in time at the year-end fiscal year-end date. But it is quite common where the general fund owes a reserve fund a balance as of the year-end. We do not like to see that because it's a contravention of the Act. And as you previously mentioned, it's basically kicking the can down the road. Eventually, the owners will have to pay higher fees. And if you're not earning the interest income that the reserve fund study had planned for in the reserve fund, ultimately that shortfall will have to be made up with higher fees to owners down the road.
Mm-hmm. Yeah, and I think from a property management standpoint, my concern for my board and for that corporation would be that now you have this whole other thing that you have to manage. You have to specifically manage that you're going to have enough cash in operating to make those contributions before the fiscal year end. If you don't, you'll end up with the auditor actually including a note correct, Jeremy? On the audit?
Correct. Personally, we always include it. Not every auditor does, but the Condo Act does require an auditor to make a specific comment in the auditor's report to that nature. And we always do when we have a material amount owing from the general fund to the reserve fund that year.
When I'm putting loans in place for condo corporations and I collect their disclosure, it's probably one of the more common notes that I see where there's another matter written up in the audited financial statements as a shortfall in the reserve fund contributions.
Okay, so they're actually securing a loan as a means to be able to make those reserve fund contributions?
No, it's just you kind of see, like, typically when you have a corporation that's in financial distress, you'll see evidence of it in a number of different ways. So yes, they need money in the reserve fund for some other reason, but what we will also see in their audited financial statements is that the operating fund has not contributed to the reserve fund. That perhaps contributes to the problem, to the shortfall that's causing the need for a loan. But usually it's just indicative of a pattern of under budgeting.
Right. Yeah, it's and probably that pattern, in addition to under budgeting, is probably bigger with respect to managing for good financial health in general, right? And good financial health management practices is what we're going for. So I think that the principle we can take out of that is a not-for-profit corporation does not mean you can't have a surplus. You're a not-for-profit corporation. If you have a surplus, the reason you have that surplus is because you're going to spend that money. It's just not going to be spent right then and there when the budget is done. So budget for a surplus as much as possible. Some corporations find themselves in a position where there is no surplus, and it's tough to get all of that back in 1 year. But it's a good practice, I think, and you guys tell me if you agree with me, to just set a goal. So work with the board, set a goal. Here's a surplus that we think is healthy, that the board thinks is healthy, that advisors and experts think is healthy. Let's work toward that over however many fiscal years we think is reasonable to build the surplus until we get it where we want.
Yeah, I think that's exactly the right practice, right? When you are working on setting a budget, it is about setting goals for your upcoming year. And sometimes those goals are multi-year phases, right? And that's the notes to the budget are so important from that perspective, right? To make sure that if a decision like that is made, to do it over multiple years, that you preserve that intelligence, so that the next time someone comes to sit to do the budget, they know that that was the goal, because it's not always the same manager year over year. Those notes are so important. From the other side, there are condo corporations that find themselves with too much surplus. And that multi-year kind of phasing strategy that you talked about, that's applicable even if you have too much money. Because what happens is if you have a big surplus and you want to use that money to offset the amount the owners have to pay, you want to start to utilize it. It has the effect of bringing in more revenue to your current year budget, or I should say your upcoming budget. It does not have the effect of reducing your expenses. So if you use all that money in 1 year, what happens next year is that the owners realize 2 years of increases all at once. Mm-hmm. And so you can use a multi-year plan to slowly deplete that excess surplus and still keep, manageable sort of level increases to your condo fees.
Yeah, right. Excellent.
And just to echo those comments, I also like to see consistency in this budgeting process to avoid these one-off shocks, that sort of thing. You should try to maybe smooth increases to avoid the third-year shock when you have a reserve fund study update that says you need to start making huge contributions to the reserve fund. I think it's easier for owners and the board to stomach if you're slow but consistent with your increases, which are frankly unavoidable. And it is not a one-size-fits-all solution. Every corporation is different. I often get asked, what's a good operating surplus? But it really depends on that specific condo corporation's needs, that specific condo corporation's financial position. And if you've accumulated years of deficit, the board will need to consider, will we claw this back over maybe a bit higher condo increases the next few years, or do we take a one-off special assessment to clear that general fund deficit all at once.
Yeah. One of the principles that I always try to emphasize with my boards is there are multiple solutions to a deficit situation, but ask the question, is this a recurring expense that's going to result in a recurring cost and potentially a recurring deficit? Because if it is, it must be handled through condo fees, right? If all you do is special assess, great, the money's in the bank and now we're good for the rest of this fiscal year, you're going to run into exactly the same problem the next fiscal year. And if you keep not adding to that budget line item, then actually that gap and that deficit is going to keep getting bigger. So tailor increases, whether you're deciding between an increase in condo fees or if you're going with a special assessment, should depend on whether that's a recurring cost or whether it's a spike, right? A one-time cost.
Well, keeping in mind that an increase to the regular condo fees and a special assessment, those events are both increases to the condo fees. And owners tend to prefer stable, predictable increases over a one-time cash call.
Yeah, absolutely. Everybody prefers that. I mean, people hate special assessments, right? That's the reality. Owners hate them. Board members hate them because they have to inform owners this is what we're doing. And property management firms hate them because they're the ones that have to deliver the message, typically, right? So doing everything we can to avoid that isn't simply an avoidance of something negative. It's a good financial practice, right? Stability in what those increases are, but of course we always come back to the reality where you will have board members who say, you know, we should cut condo fees or we should have 0% increases, and our reply is always the same: what have you bought lately that has decreased in price over the past 3 years?
Yeah, I mean, managers too can flip the conversation on the board a little bit. Managers can come prepared to budget meetings to say, okay, you want your fees to go down. Let's talk about some meaningful things that we could do to change the operations of our condo that would reduce expenses. And when I say that, I don't mean undercutting services or getting rid of the concierge or something like that. I mean, like, well, let's look at our utility consumption. Are there ways that we could minimize our utility costs? You know, decarbonization, net zero, this is something that's coming in the marketplace right now. It is potentially a way that condos can save money on their operational budget, but they need to be prepared to spend it on the capital side in order to make that happen.
Yeah, so you say like water conservation techniques, LED lighting, retrofits if they haven't been done, those kind of things.
Yeah, I mean, the other thing too is I always say that the financial statements for condominium corporation, like they tell a story about the things that are going on. I can read a set of financial statements without context for a condo corporation and say, oh, well, they have this project here they need to do. Oh, their fire system is giving them trouble. So if you are on a monthly basis doing variance reporting for your board, which I think is a good practice, if you're doing that variance reporting, you have eyes over where your overspends are. You can say things to the board like, well, you know, we spent $30,000 repairing our fire system on the operating side last year. Maybe it's time to start talking to our engineers about doing a capital repair project to get that component fixed and working properly, so we're not hemorrhaging so much money out on the operating side.
Yeah, so true. I want to take a couple minutes. I really want to take a couple minutes and talk about accruals. Because again, I think this is something that doesn't get enough attention, and it can really have a significant impact on producing monthly financial statements that are accurate, especially through the large ticket items that typically have accruals associated with them, like utilities. So Jeremy, maybe you can talk to us a little bit about that. How should an accrual be done on a monthly basis? Why is an accrual done? How is it done? And what are the impacts if it's not done properly?
Of course, but first and foremost, I would like to differentiate two different bases of accounting, either the accrual-based accounting or cash-based accounting. Often people like to think in the cash basis accounting, which is essentially you're recognizing revenues and expenses when the cash comes in and goes out the door. From a financial reporting perspective, for audited financial statements and conforming with generally accepted accounting principles, they have to be presented on the accrual basis of accounting, which is basically you're recognizing the revenue when it is earned and expenses when they are incurred, regardless of when the actual cash is exchanged. So as part of the budgeting process, just to bring back to that, when you're doing the budget 9, 10, 11 months into the year, you should be anticipating what other expenses are missing from the financial statements and setting up accruals for these by year end to ensure that the year-end financial statements are essentially complete. This is something we do look for in our audit procedures, but is a very important part of the budget process. Generally speaking, a lot of management companies don't have the time to build in accurate accruals from month to month throughout the fiscal year. Often water, hydro, and the gas are estimated and accrued on the monthly financial statements based on historical data, but that's generally the extent of it. But when it comes to the year end, you should be anticipating, oh, we haven't paid 4 out of the 6 snow bills for the year. We should accrue those additional bills so that our closing net assets balance in the general fund is accurate and the appropriate expenses have been recognized in the fiscal year. Mm-hmm. Does that make sense to you, Mark?
Makes total sense. And the big danger there is, let's say an accrual is calculated improperly and there's too large of amount accrual. Now, when you're talking about your big utility items, that can be a big number, right? That can be a $5,000 accrual that ends up being a $15,000 accrual. And when the set of financial statements is produced for that month, the accrual hasn't been backed out yet. That set of financial statements shows that line item as being in a $10,000 deficit, right? Misstated, right? Incorrectly stated, $10,000 deficit. So now the board is going to get that. They're going to review it with the property manager, and they're looking at incorrect information that probably they're going to be making decisions on.
Oh, for sure. And often this is a question that we do get asked when the draft package is provided to the board. Why is the draft so different from the year-end package that management provided them? Often it's because management hasn't accrued major expenses. If there was a water leak in November for a December year-end and the bill wasn't received until February, there may be a $20,000, $30,000, sometimes $100,000 bill that wasn't accrued in the fiscal year, but that work was completed in the fiscal year and it needs to be recognized in that fiscal year.
Yeah, for sure. Yeah. So I think coming out of that, a really important reminder, managers, make sure that your accounting department is performing accruals properly. And if you see that something doesn't look right or there's some red flags, go and sort it out. And boards of directors make sure that the management firm's accounting department is doing those accruals correctly. It's not a bad thing for the treasurer to understand in detail how an accrual is performed. And it's not that complicated of a process, but it's a good thing for everybody to be aware of.
And even if it isn't built into the year-end financial statements, it should still be covered in the budgeting process. So although it may not be accrued, the budget should anticipate accrual when setting the budget for the upcoming fiscal year.
Yeah, the projection process, right?
Yeah.
What will my number be by the end of the fiscal year? If I don't have visibility of what my ending financial position is going to be, I'm not going to be able to prepare an accurate budget for the upcoming year.
Exactly. Yeah. So calculating those projections becomes very, very important, right? And it's a bit of a double-edged sword, I find, with projections, because you want to start the budgeting process as early as possible, right? You want to get a good jump on it. But the reality with budgeting is it's like forecasting the weather. The closer you get to the day, the more accurate it's going to be. I had a property for a while that their policy was they did not release the budget for the next fiscal year until 2 months into that fiscal year. And so then they would put on, they would just add to that first month what the difference was between the condo fee amount for those first 2 months. So probably not a good practice, not one that we can do now, but it's an accurate budget because projections are not projections. You're dealing with actual numbers in every scenario.
Yeah, but I mean, a budget, when you're doing a budget, perfection is not the standard, right? You're not trying to exactly guess how much money you're going to spend through the fiscal year. You're trying to develop a plan that is going to support the amount of money that you need to operate. Variances, when you're running a zero-based budget, variances are very common. They're normal things. They're another reason why we maintain healthy surpluses. Um, you cannot ever accurately predict exactly what 12 months is going to look like. There's too many variables. But using historical performance from our accurate audited financial statements, using our expected performance with projections to the end of the fiscal year, this should give us enough data, I mean, alongside all the other records of the corporation, to give us a budget that is reasonably accurate. You don't need to wait until 2 months into your fiscal year, create all this extra complicated accounting for people to untangle throughout the year. Just follow the course and use sound principles and you'll be fine.
Yeah, for sure. And, that's one area where the property manager's knowledge of the corporation's year, what events happen and what major expenses are occurred is so important, right? What if, for example, you have a December year end, you do your annual fire inspection and any of the upgrades and repairs work that needs to be done as a result of that annual fire inspection. And maybe that happens in November, right? You're working on the budget in September, October at the latest. You better make sure that you've included that as that you forecasted that expense, because that's going to be a major expense. If you're looking back through your fire safety line item and you see, wow, we're $10,000 under budget. This is fantastic, right? The board's going to be so happy, but you haven't actually forecasted that yet. You're going to end up in trouble.
Yeah, and this is an area where the unaudited financial statements can be more helpful than the audited financial statements, because you can look at different periods of the fiscal year and see what the corporation's typical performance is in a single month.
Right. Yeah, for sure. And I think the other aspect there is making sure that there are historicals included in the budget draft that you produce and the budget draft that goes to the board, right? So, having just what happened last fiscal year and what is happening this fiscal year and what we project to happen through the balance of the fiscal year, it's not enough. You need to see past years of history for the board to be able to see, okay, we spent this in 3 years ago, 2 years ago, 1 year ago. There's going to be some variances in there. Can we account for those? We should be able to, and that really does help to create not only an accurate projection for what's going to happen this fiscal year, but also an accurate projection of what we think roughly we're going to spend in the following.
Yeah, it can help you too to see where you have routine variances, where you might want to adjust your budgetary practices. If you're out of line with your budget in a particular category every year for the last 2 or 3 years, what's the reason for that? Is it a recurring issue that maybe needs to be budgeted on its own? Do we need to consider how our expenses are actually grouped from a budgetary perspective? So you can make adjustments in the budget process to better suit the future financial position of the corporation. You're not always stuck with how you did it historically.
Right. So we should be using those as cues for us in terms of how we adjust the budget and make changes going forward. And something to add also to the issue of accruals in terms of making sure the monthly financial statements are accurate and the board's getting accurate numbers to look at on the income statement each month, is making sure that we seasonalize our budget. It's a big issue. Maybe it's not that big of an issue the farther south that we go, especially into the US or in other areas, but we have such a huge weather change here. Minus 40 to plus 40, there can be massive difference between the amount of hydro that we consume in the summer months compared to a much smaller amount of hydro we consume in the winter months, depending on how our corporation physically is designed. And the similar things can happen with water. If we have an outdoor pool that needs to be filled every year, and then the same thing with gas, right? We use a lot more gas typically in winter months again, depending on the setup of the building. So if that's not done, what happens to the income statement through those months? That's a question.
Well, you see major variances in those months, right? So when you seasonalize or weight your budget to a particular period, you also input that data in the back end of your accounting software. And so we have comparative lines that show you your year-to-date budget that should be seasonalized so that you're eliminating variances that aren't true. What you don't want is for your board to make financial decisions based on a variance that doesn't actually exist. If I'm under budget for hydro $20,000 in this month, I don't want to spend all that $20,000 if it's just a seasonal variance. And so having that weighted budget in the background, helping to support the discussion about variances in the financial statements, that really goes a long way to making sure that your board has the information that they need to make accurate decisions. The weighting of the budget as well will help corporations to better understand what a healthy surplus position is for them, because they can actually see where those months are that they have chunkier expenses that's taxing their cash flow. And they can use that number to understand how much extra cash they need to be carrying in the bank. There's no hard and fast rule for how much surplus you should have. It's a little different for every condo corporation. Some people, myself included, will say, well, it's at least 2 months of expenses. We can use that as a starting place. But seasonalizing the budget really helps to drill down for that condo corporation what will make sense for them.
Really good points. Yeah, for sure. We're going to run to about 10 after, which means our time is winding down. What I'd like to do is ask each of you for, first of all, any important points, any things you wanted to really discuss that we haven't got to yet. So maybe, Jeremy, we could start with you.
One thing I'd like to touch upon is also the tax filing requirements of condo corporations. Condo corporations are a corporation with obligations for CRA tax filings. Most have to file a T2 corporate return as well as a T1044 not-for-profit information return if it meets one of the criteria. And these are things that should not be ignored. With a 1044, there are late filing penalties. And if it's not filed, you can be levied the maximum penalty. So it should not be ignored if you're a condo with less than 25 units that chooses to dispense with an audit. These often the auditors are requested to e-file the T2 corporate returns and at least prepare the 1044 not-for-profit information return. But also that's by no means the end of the tax filing requirements. Is also employee remittances requirements for CRA, often HST requirements if there's other ancillary sources of revenue. But generally speaking, residential condo fee revenues are exempt from HST, but there's other exclusions from that. For example, commercial condo fees have HST subject to them.
Right. Super important. Thanks for bringing that up about the tax implications and CRA. Let me ask you something, and maybe putting you on the spot a little bit because we didn't talk about this question previously. Is it possible for a condo corporation to lose their not-for-profit status?
I personally haven't seen it, but I don't know.
I've never seen it. So it's not common at all, but in theory, would it be possible? Or are they by nature, they are a not-for-profit organization?
I've actually thought about this a lot, and we didn't prepare for this question.
Yeah, so I'm sorry to throw it at you.
I have thought about this a lot because in the Toronto market specifically, there is some chatter about whether or not condo corporations have the opportunity to bring in revenue outside of from the ownership. And that event kind of could cause some problems from a not-for-profit status. Right. The way a condo is meant to operate is the money comes from within. Right. And the challenge is that if a condo corporation did lose its not-for-profit status, it would be a very bad thing. There would be significant corporate tax implications. And so if a corporation found themselves in a position where they thought, well, I'm going to bring in all this revenue, and that's going to be good, it's going to, reduce what the owners have to pay. Is that revenue going to be long-term sustainable enough to support any tax implications that could come? We haven't yet seen a condo corporation that wants to be a test subject.
Right. I wouldn't recommend it personally, but generally speaking, condo corporations are never pursuing profit. If they are pursuing small amounts of profits, like guest suite revenue, things like that, they are certainly subject to HST if they've exceeded the small supplier threshold of 50,000 for not-for-profit organizations. But I've never seen a condo undertake a profit-driven activity that could jeopardize the not-for-profit status with CRA.
Right. And I think CRA understands that there may be some activities that the corporation shares in or services or something that they can offer that, do kind of generate revenue. But as long as that number is not high and it's obvious that the corporation isn't pursuing these other methods of revenue streams, then there doesn't seem to be an issue with it. I'll use one example. There are condo corporations that are very tall towers that have communication towers installed, and companies like Rogers and Bell and so forth will pay the condo corporation a monthly amount or a quarterly amount in order to keep their tower up there, right? Which can actually be a significant amount. But CRA has never seemed to have an issue.
As long as you don't surpass your HST thresholds.
Right.
And that source of revenue
Right, okay.
is subject to HST.
Right. Yes. Yeah. Okay. Good. None of this information constitutes financial advice. Just as the reminder there. Lyndsey, sorry, Jeremy, was there anything else that you really wanted to make sure we cover?
No, I think that's the last thing I wanted to address.
Excellent. Lyndsey, any important points that we missed?
I think that the only thing that I really want to express the importance of is good fiscal practices from a budget and cash flow perspective on the operating side prevents you from doing damage on the reserve fund side, right? The reserve fund side, the reserve fund is intended for major repairs and replacement of your capital assets for a condominium corporation. If you have bad practices, budgetary practices on your operating side, it can actually result in a condo corporation sort of trying to nickel and dime their reserve fund to death. Oh, we have a variance. We'll just expense this from reserve. We'll just expense that from reserve. Don't do that to yourself, right? Set your operating budget up for success so that when you need that money for capital repairs, it's still there for you.
Mm-hmm. Yeah. It really can happen. And you use the expression nickel and diming. And it's like, it can be $4,000 here, $7,000 there. We don't think it's very much one time, but those things add up. Right. And that can be a real big hit on your reserve fund. And then you have a big project that the money's supposed to be there for, and it's not. Yeah. So now we're talking special assessment again, right? Yeah. So yeah, super important. Takeaways. Let's try and highlight any takeaways that my Siri is going off for some reason, and she's wanting to record everything that I say here. Okay, let me just, all right. I think she's happy now. So let's hit some of those takeaway points. Jeremy, if there's 2 or 3, what do you think they would be from your standpoint?
I don't think there's a one size all fix for any condominium corporation. Every condominium corporation needs to assess their own situation with the experts that they employ, whether it's the property manager, lawyers, accountants, engineers, to come up with a prudent fiscal management process to suit themselves and not get themselves into a hole. You can't look at any one part of the financials in isolation. You have to consider every aspect of the general fund, being the balance sheet, income statement, as well as reserve fund, and everything has to be considered as a whole to move forward. And please don't run ongoing general fund deficits, because that will hurt the owners and the reserve fund and everyone at the end of the day.
Excellent. Excellent takeaways. Lyndsey.
Honestly, I have one main takeaway, and that is to just remember that the budget, the financial statements, the financial position of the corporation as a whole is something that has to be managed all the time. It's not something where you get an audit, you put it in a drawer, you do your budget, put it away, get a financial statement, you talk about it one time. It's not. You really have to actively manage these things throughout the fiscal year.
Right. Yeah. Fantastic. Thank you so much. Jeremy, this is a super busy time of year for you right now. Right. Tell us about what your schedule is like and what OHCD's schedule is like this time of year.
So as previously mentioned, December year ends are by far the most popular year ends, and the requirement is to have AGMs within 6 months after year end, as well as tax filings are due 6 months after year end. So currently we're up to our eyeballs in AGMs booked every night, sometimes 6, 7, 8 AGMs a night, just because everyone often leaves their AGM scheduling to the last 2-3 weeks in June. So we do encourage people to be a little bit more proactive, prepare for the year-end audits, maybe book the AGMs a little bit earlier, anticipating when your audit will be finished just to avoid this year-end rush. And often we don't get booked for AGMs or asked if we're able to attend. We're just told when an AGM will occur and we need to be there. So we're often juggling many a night, and just bear with us if we're attending several, and you won't be the first one at 7 o'clock, for example.
All right. So get that request into the auditor early, right? Because you guys are chock-a-block this time of year with visits to AGMs.
That'd be very much appreciated.
Property managers, I'm sure, will do their best. Lyndsey, you have an event coming up tomorrow that you're also in Ottawa for?
I'm in town for a golf tournament tomorrow. I don't really golf, but you'll find me around the course causing trouble.
Good.
Yeah.
Good. Like just kind of scaring people, jumping out of the bushes. And
I don't. I'm not a scary person. I don't think.
No.
No.
Right. That's true.
Yeah.
Yeah. Good. Like, will you actually golf?
No.
No. Okay. All right.
I just like to come out for the fun.
Yeah.
Yeah.
Well, it's nice, right? You get to drive around in the little cart, which
Yeah.
is fun. And there's usually good food.
Yeah, some music, some sun, good people. That's what I'm there for.
Nice landscaping, nice course,
Yeah.
and good conversations, I'm sure, with people. It's CCI?
Yeah, it's for
event?
CCI Eastern Ontario.
Eastern Ontario, CCI Eastern Ontario. Shout out. Very excellent. So I need to do a shout out, first of all, to my producer extraordinaire and also IT guru extraordinaire, Johnny D. Johnny D on the backbeat, backing us up here. John Dozwa with Dozit. Thanks so much, John. Monika, who's been sending me some questions, which I'm really, really sorry. I've chewed up the time and I didn't get to. So what we're going to do is I'm going to send any of the questions that came through. If it's something that I would normally answer from the property management standpoint, I'll do that. If you guys don't mind, I'll shoot them off to you if they're more your thing. And I don't know if you can shoot an answer back or something, or we can have a phone call about it.
Yeah.
That would be awesome. Oh, and I don't know if you know, but we have sponsors now.
Oh.
Yeah. No, amazing sponsors. We started it last podcast, and we have. So do you want to know what we have? 2 sponsors.
Who are your sponsors?
Okay. So our first sponsor is Spreadsheets. Sponsored by Spreadsheets.
Okay.
Spreadsheets. We can destroy your budget with one wrong formula. Spreadsheets. It's not a great slogan.
I don't think so.
Because there's good things about spreadsheets.
Yeah.
They could highlight that instead of highlighting,
Someone said to me recently, he says, I don't care who's prepared that spreadsheet. You can always find a mistake in a spreadsheet. And I said, you're not finding mistakes in my spreadsheet.
Agreed.
Excellent. Love it. That's only our first sponsor. We have a second sponsor. You want to know what the second sponsor is? Coins. Yeah. Coins. Still? They're not good, eh? No.
No, they need to work on their marketing a little bit.
Yeah. And also, I don't know how I'm going to get my money from them.
Through coins.
So last podcast, it was trees and grass, because it was a landscape, it was a summer maintenance podcast.
Yeah.
Haven't seen a cent. Probably going to have the same problem. We'll see. I need better sponsors. My marketing people maybe need to do some more. Yeah. All right. Have a great golf tournament tomorrow.
Thank you.
Have a great, safe, relaxing couple of glasses of wine train trip back to Toronto. Jeremy, hope you can keep your head above water over the next month or so with all those AGMs that you and the firm have to attend. Thank you for all of the amazing work of OHCD with respect to audits. Thank you, Lyndsey, for all the amazing work of Condominium Lending Group, not just from the lending standpoint, but from the standpoint of good financial guidance for condo corporations. This has been really fun. I hope you guys enjoyed coming.
Yeah, thanks so much for having me, Mark.
Thank you very much, Mark.
All right. Have a great afternoon, and thank all of you for joining us. John, do we have a number on how many connections we had today? 230. Fantastic. We had about 370 registered, 230 on. That is an amazing number. Thank you guys so much for taking the time today, and we'll see you next time around.